Citadel's flagship hedge fund gains 29% in year of market turmoil. And get this, hedge funds suffer $32 billion of outflows in Q2 data. And what do you think the average North American hedge fund has returned in 2022? Well, if you thought it was a positive return, you would be absolutely wrong. Returns fell 8.82% in North American focused hedge funds, even whereas European counterparts fared slightly better with a 5.78% decline. Hedge fund returns focused in the Asian Pacific region fell 4.45%. So how is Citadel doing this? And what does this ultimately mean for us? Because let's be honest, Citadel is behind a lot of our stocks. If you have a stock in your portfolio which is down, mathematically, Citadel is probably behind it. They are one of three major market makers that essentially takes the opposite sides of your trades. Now, it gets a lot deeper than that, and we will talk about it here in this video, but that, ladies and gentlemen, is the punchline, what we're going to talk about here in this video. So if that sounds like something you are interested in learning about, highly recommend you guys stay tuned for this whole entire video, and I do highly recommend that you hit that like button, subscribe to the channel, you source your comments, questions, or concerns down below in the comment section. Thank you guys for doing that. Now let's get straight into it. So we're gonna start with the article on Citadel, and yes, we're gonna talk about AMC. We're gonna look at the Ortex data intraday here today and talk about some unemployment numbers that came out, the ADP employment change, which is giving us a little bit of this negativity here in the markets today. So Citadel's flagship hedge fund gains 29% in year of market turmoil. Firms for hedge funds enjoy double-digit returns this year. Ken Griffin's firm is outperforming peers in rocky 2022. It says the company's flagship Wellington Multi-Strategy Fund returned 2.5% in September, bringing year-to-date performance to about 29%, the people said, asking not to be named because the information is private. Now, if you guys remember September, which hopefully we all do because it just passed, and if you guys watch these videos, then you know September was the worst month for the stock market in 20 years. Yes. You have to go back to 2002 to get a worse month than what we've seen in September, which is wild if you think about the COVID crash, if you think about everything that's happened in 2022. Some of those days we were going down 3-4% back to back. September was actually worse than that, and just because there was very little up days and the down days were pretty substantial, and they definitely did add up. Now, how the hell is Citadel returning even 2.5% on billions of dollars during that time period? Well, we're going to talk about that in just one second. But it does say Ken Griffin's firm saw its global fixed income fund climb 1.3% last month, bringing the year's return to about 24%, the people said. Its tactical trading fund climbed 2.4% in September, driven by fundamental long, short, and quantitative equity strategies, taking this year's gain to 21%, they said. Citadel equities rose 2.5% in September, with a year-to-date performance reaching about 17%, they said. It says, in a year of market turmoil, Citadel has navigated choppy waters to deliver investment returns that beat rivals. A Yorkridge hedge PTE index that tracks hedge funds globally has lost 5.7% this year, heading for its worst annual performance since 2008, according to a preliminary data through September. Now, let me be honest with you guys. Citadel is the main market maker for the stock market, right? Then you have Goldman Sachs, and then you have Virtue. Those three guys are it. And guess who the best performing people of 2022 are? It's the guys that are market makers. Because why is that? Well, think about it like this. You can get super in depth with it because the stock market is like multi-layered, right? But think about it like this. If you bought a stock, right, that has went down in 2022, whether it's AMC, Square, PayPal, SoFi, DraftKings, Affirm, or any of the other stocks I personally own that are down a lot for 2022, someone else is on the opposite end of that trade, meaning that somebody shorted those stocks in order for you to do that. It's kind of how the markets work, especially when you're dealing with market makers, right? To keep everything fluid and liquid. Well, that's why the market makers are performing the best, is because they're taking the opposite end of this. And that's why the down days really bad for AMC. Like today, let's go ahead and look what AMC is actually doing today. Down almost 10%. The S&P 500 down 1.76%. It's because the down days are very bad, and then the up days are very, very good. AMC had a 14% positive day yesterday. That's because a lot of these market makers that take the opposite ends of these trades, ultimately, when things do bounce, they have to try to get out of their short positions very, very quick. The other factor, to a short squeeze, just besides that, would be, these market makers trying to get out of these positions really quick, and then to get additional volume, to get some kind of catalyst that gets people excited. If you get something like that, on the same day, then you're looking at 20, 30, 40, 50% gain, possibly in a single day. And I do think that is still on the horizon for AMC stock, and I don't think this trade is over, and I don't want you guys to forget that there is something very, very powerful about everyone knowing about AMC, no matter if you're Warren Buffett, no matter, obviously Citadel knows about this, but if you are in the stock market and have been in the stock market, call it since 2020, just over the last 2 years, almost 3 years now, you know about AMC. And there's power behind that, because if you were in AMC, if you've been watching it from the sidelines, if you've been laughing at people that have been investing in it, well, when that stock really starts to make big moves, it's going to get more people into the stock. It's kind of like, and bear with me here, it's kind of like how McDonald's advertises, right? It's not so you see a Big Mac on TV and go buy one, right? That's not the kind of advertisement they're doing. It's so next time you're, thinking, where should I get some food? Well, your internal memory has seen so many McDonald's commercials, that shit cannot leave your head. Whereas like KFC or something else that's lesser known, you don't think of that right off the top of your head, right? That's just for an example, and that's kind of the way that you can look at AMC. It's in everyone's head. Everyone knows about it. So especially with these market makers having great returns throughout this down period in the markets, basically when things do get good, they're going to be on the wrong side of this equation, and you are going to see an epic market-wide short squeeze. There's no other way to put it. Now, this article I find very, very interesting. So hedge funds suffer $32 billion of outflows in Q2 data. It says investors pulled $32 billion from hedge funds in the second quarter of 2022, spooked by inflation, geopolitical tensions, and the war in Ukraine, according to a report from data provider Preqin. The outflows were the largest that the $4.1 trillion hedge fund industry has seen since the start of the COVID pandemic in the first quarter of 2020. The declines may continue as central banks continue to raise rates, Pequin said. In September, central banks in North America and Europe increased interest rates in order to curb inflation. Meanwhile, a surge in UK government bond yields hit British pension funds, forcing some to seek emergency funds from the companies of which they manage money. Bond prices fall when yields rise. And that's a big thing. That's a big reason what's going on in the UK right now, where the central bank over in the UK had to actually step in and start buying bonds again. It's because a lot of these pension funds were literally about to go belly up because of what happened in the bond market. So there's that. It says global uncertainty, quote, put significant pressure on markets and force investors to revisit their allocations, the report said. And you guys can see this pretty little picture. This is the worst outflows by far in 2022, 2021. You have to go back to January 2020 to get a steeper outflow than what we have just seen. And specifically, North America and Europe have seen some really big outflows as of the last couple of months. Now, It says lackluster second quarter returns have not encouraged investors to stay either. Like I said, returns fell 8.82% in North American focused hedge funds. That is a very steep decline. And for all of these losers, there's going to be some winners. And Citadel is obviously a temporary winner in that situation, but it's not going to last all too long. And like I said, guys, if you want to go back and re-listen to that whole example that I just gave, I highly encourage you guys do that, because I've been in the markets for a very long time. I've seen this happen before. You've seen certain hedge funds do really good during down markets and then really bad during up markets, right? And it's like crazy, because you wouldn't think that. Because even look at like Archegos, look at some of these other firms that were doing very, very good and then all of a sudden started doing very bad even in a good market or when the markets were booming. So there's all that information. I figured you guys would probably want to know about that and get a little call it reminder how the system actually works, especially in regards to Citadel and them taking the opposite end of our positions, right? If you have a position right now, odds are Citadel has the opposite end of that. If you're down on your shares, Citadel is probably up on their short positions, and vice versa, right? So when those tides flip, oh boy, are they going to flip big time. Now, as far as today, you are seeing that businesses added 208,000 jobs in September, better than expected, the ADP reports, and that's not good. You want to see less jobs, and that is what is going to give the market short-term bullishness, but it's going to be something that makes the Fed say, hey guys, we should probably slow down and at least give the economy, the markets, room to breathe here. We've got a 25 basis point rate hike, 50 basis point rate hike, and then 3 75 basis point rate hikes back to back. If we get another one November 2nd, the next time the Fed meets, that's going to be 4 back-to-back 75 basis point rate hikes. 2 of them has never happened before. 3 of them unprecedented. 4, that's like off the charts, right? So I think a lot of people are expecting the Fed to come in maybe with a 25 basis point rate hike at the next Fed meeting, or possibly not raising rates at all at the November meeting, especially because of midterms. And historically, midterms tend to be very, very bullish for markets. Now, as far as AMC and the Ortex data for the day, AMC is starting to come up a little bit as we currently speak, and you are seeing a 70% positive order value for the day. Let's go ahead and refresh this actually to get the most up-to-date data. It's 73% positive order value, 5 orders totaling $88,000. So not huge on the dollar amount, but definitely skewed to the positive side as far as the positive order value. As far as the short interest in dollars, the total amount of short interest in dollars, that is sitting at $774.87 million. Estimated short interest of free float at 19.2%. Free float out on loan 36%. Shares out on loan 185.77 million. You do have the cost to borrow at 17.87%, and current cost to borrow max sitting at 39.18%. Cost to borrow average at 27.22%, and a big reason why the cost of our max is at 40% is because of these big moves that we have been seeing, right? If a stock has really big moves, the cost to borrow is going to be a lot higher, and you're going to have a lot more potential to continue to see big moves in that stock, relatively speaking, to something that moves a lot smaller. Short cost to borrow max going to be a lot lower. So guys, that is it for this intraday update. Hopefully this provides you guys some clarity on what the current situation is with hedge funds, with Citadel, specifically with AMC and a lot of the stocks that we own, because over the last 2 years, or really even in 2022, it's been the year of the retail investor. Retail investors have really been holding shit together, right? We're not capitulating. We're continuing to buy the dip, and you've seen record inflows, still over $1 billion every single day, that retail investors are putting into the markets, even on days and months where you're seeing 20-year records for the worst performing month. You're still seeing over $1 billion of retail money going into the stock market every single day. So Hopefully that provided a little bit of clarity on the situation. We will be back about 4 p.m. to talk about everything else that is happening in the markets today. What's going on with OPEC? What's going to, happen by the end of the day? We'll talk about it later on today. So thank you guys for watching. Hit that like button, subscribe to the channel, source your comments, questions, or concerns. Like I said, down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description as well. We just put on a really good trade. Very, very excited about it, guys. So you guys might want to be a part of it, might not. Never a financial recommendation, none. The less free stocks down there with Webull, Moomoo, and Public as well. Check that out if you guys have not already. Thank you for watching, and I will see you in the next one.